And I would say a lack education drives the focus just where most of the wealth is for most individuals working class that is allocated to qualified plans, which case IRAs that are sponsored by an employer, in which you're very limited in the assets that you can invest that for the proceeds of that 4K into, which is primarily in stocks and bonds. And so a lot of that is kind of the driving factor for that. And so for most people, they're not educated on alternative investments. They don't have the knowledge on how to find great operators, how to find great deals to invest directly and buy those hard assets themselves.
Welcome to the Property Podcast, where great minds in real estate get together.
Welcome back to the Property Podcast. I'm your host, Angelina, and we're joined today by a guest who brings a unique level of precision and a strategy to the world of real estate, Johnny Lynum. Johnny is a retired U.S. Force Lieutenant Colonel turned multifamily investor. Today, we're exploring how to move away from the daily grind of active property management and start building long-term financial security through institutional-grade multifamily assets. Welcome to the show, Johnny.
Thank you for having me. Excited to be here on the show today.
Of course. So, Johnny, you served 20 years in the Air Force. How does the high-level strategic rigor help you analyze a multifamily deal differently than a typical investor?
That's a great question. And a lot of times I share with veterans that have served in the military forces, because a lot of times it's not always apparent the skill sets that we bring from the battlefield and the missions that we lead into bringing into business, and especially into real estate. But I think one of the, I would say, largest contributing factors that gave me the confidence and the strength to kind of go to the next level into multifamily was definitely just my risk tolerance. And one, being able to put risk in context to the deal, the property, in the grand scheme of things, and not being overwhelmed by the micro, but being able to operate at the macro level when we start looking at risk tolerance and the impact of realized risk to the portfolio and to the individual deal, especially when you start looking at value add type of multifamily.
Great. So in the military, mission success depends on planning for every variable, correct? So what are the key flight checks you perform before considering an institutional investment?
No, I think that's a great question. That a lot of times the due diligence, especially when you start talking about on the 1031 side of things, when you really have the 45-day timeline to identify replacement properties, and you're really sometimes, depending on the level of inventory, especially over the last few years with the lack thereof, that it could be extremely stressful. And a lot of times you don't go into that level of due diligence, or you see the fancy brochure, the pitch deck, and you're really not diving into the actual numbers and to the experience of the operator. So for me, I think really understanding the environment that you're buying in, so the economy, what's the story? What's the story with the property? What's the story with the business plan? What's the operator's story? And from there, does everything make sense? Does it align? Does the assumptions make sense when you start looking at the exit cap rate, where they're buying, the renovations, the renovation budget? Is there enough specificity in there where you're confident that they'll have enough budget to do the renovations? But then also, how aggressive are their rents that they're projecting that they're going to increase rents, or the reduction expenses? Does it seem realistic? And I think a lot of that comes, you get a confidence from just overall experience. The more you do it, the more you underwrite, the more you see deals go full cycle, that you'll have a better appreciation for the details that really matter on just the overall performance of a multifamily deal.
I see. So many people are exhausted by the tenants' toilet and trash. So can you explain the concept of an institutional exit and how it changes an investor lifestyle?
That's great. That's great because, I would say now that I think I've kind of crossed over that bridge now to really having a true appreciation for the passive side of investing after, doing multiple deals on the value add and active income side. But I think on the passive side, that it just brings a wealth of information, I guess a wealth of opportunity and benefit to the investor that a lot of times in your younger years, you're not necessarily focused on. I think the number one is just the passive side of it is number one, where you're not in the day-to-day operations. that you can focus in on whatever it is that you really hone into when it comes to building wealth and really, with generating income. But I think also that you have to pay attention to the opportunities that come with, not having risk in regards to having recourse debt, where you're only limited to your investment in the property. And so I think a lot of that goes into the risk tolerance. And as you go and increase in age, that you're looking to take some chips off the table, you're looking to reduce your overall risk exposure. But I think, also when you start talking about the institutional deals, that you guys start thinking about estate planning. How does your insurance policies line up with everything? Your cost basis. Are you looking to pass on assets to heirs? Are you maybe looking for a DST where you can take all those deferred capital gains from multiple 1031s and roll them into a DST with the ultimate destination being a 721 REIT, where now you can bring it into and have individual shares that you can break up in your trust and align to however we would like to gift those, with the step up basis and the complete deferral of those taxes along the way. So I think it gives you a lot of different opportunities on the institutional side where the returns are a little bit less, but the risk is right there in line with the returns that you're having, where you don't have to worry about catastrophic loss, and really the institutional side of it, when you look at the type of tenants that are at these properties, the management that's in place, when you start talking about multifamily, but the tenants really on the triple net leases, when you start looking at some of these recession-proof businesses and anchors, where you have firms that have had zero missed payments from their tenants over 20, 30 years, just because you have great tenant base in some of these retail triple net leases that are really great for investors long term.
That's pretty informative. Thank you. So, you often mention that high earning professionals are overexposed to Wall Street. Why do you believe hard assets like multifamily provide a more reliable foundation for financial control?
That's a great question. I think really it's just from a lack of knowledge, a lack of education. And I would say a lack of education drives the focus, just where most of the wealth is for most individuals, working class, that is allocated to qualified plans, which case IRAs that are sponsored by an employer, in which you're very limited in the assets that you can invest that for the proceeds of that 401k into, which is primarily in stocks and bonds. And so a lot of that is kind of the driving factor for that. And so for most people, they're not educated on alternative investments. They don't have the knowledge on how to find great operators, how to find great deals to invest directly and buy those hard assets themselves. And so there's an education piece. And then on top of that, a lot of the institutional deals are only reserved for accredited investors, unfortunately, that meet the net worth requirement of having at least $1 million net worth, or a single individual with an income over the last 2 years of 200,000, or a couple with 300,000 of annual income over the last 2 years. And so there's some barriers to prevent people from being able to get more exposure there. But I think once it goes back to really the education and understanding how you can bring real assets into your portfolio, the benefits that come with them, with the tax breaks, the hedge against inflation, and then also just the diversification from the roller coaster that comes with the stock.
Interesting. So, what is the property number 3 rule, and how does it serve as a tactical backup for an investor portfolio?
Yeah, no. So the property number 3 rule, and really for me, really we're working with commercial brokers and investors, is really having a institutional deal in that third property slot. When you look at the 1031 rules, that you need to identify, you can identify the 3 properties within your 45-day window after you close the sale of your property. And so for one of the strategies that I love working with commercial brokers is really having that DST as a backup property. If they're unsuccessful in finding an actual property that the investor wants to buy outright, or if the deal falls through, that they have on that third property, which being a DST, as a backup, just in case something happens during due diligence, once they move forward with maybe property number 1 or number 2, that they have a backup where they don't lose the 1031 exchange benefit and have to actually pay the capital gains taxes on the sale. And so that's one of the things. It's really an insurance policy for the investor and the broker, where the investor can still walk away with the deal in the DST. And some, depending on their age, that they look to come into the DST just for those reasons that we talked about earlier, where they're tired of being an active manager. They want to be more passive, but they don't want to give up a large lump sum of their capital by way of taxes. And so one of the cool things that we can do with those 3 properties they identify, that they can bring in 3 different DSTs and build a diversified DST portfolio where they can diversify amongst the operator, but then also diversify amongst the real estate asset classes, and then geographically, and then also with the tenant base as well too, to have a truly diversified portfolio amongst different DSTs.
That's something pretty interesting. I never knew about it. So thank you for that. So, in your work with accredited investors, what is the most common fear that they have when moving from the active management to a passive institutional assets? And how do you strategically address that pushback?
Yeah, no, that's a great question. It's really that suitability for the DSTs is going to be different for every client. I would say one that comes up more so than not for a lot of guys is the control. I'm the same way as a multifamily owner. That one of the things that pulled me into real estate and not really going all in on the stock market was just being able to control the deal. That I can go in and control the forced appreciation. I can control the day-to-day operations, and I know I'm going to put the work in to do it. And so for a lot of people, it's giving up that control, because the one thing is, once you make that investment, that it's illiquid. Your money is going to be tied up from anywhere from 3 to potentially 7 or 10 years. You don't have control, and you're really all in on that company because they're gonna lead it. And which the great thing is that there are sponsors that have issues, but that's why my role as an advisor is really digging in and finding the top tier players in the DST space where we can make sure that they have a great operator at the helm of the controls. Because at the end of the day, you want to make sure you're giving control up to someone that's earned that privilege of being able to take your hard-earned capital and have it in a property they operate. I think that's how we hedge that concern on losing control, is really aligning with the best players in the DST space and really being able to dive into the details to make sure that it's a suitable investment for the client.
Interesting. So, coming from a project management background, just like I do, in the intelligence community, how are you currently using AI or advanced tools, data tools, to sharpen your sustainability reviews for multifamily properties?
Yeah, no, I think that's a great one. I think really is really for me, I would say number one is on the investor side of things is working with Chat GPT and building my own GPT to do underwriting. Once I receive a rent roll, once I have financials or a trading 12 report, that I can dive in and have the initial analysis performed by Chat GPT. And then now I can go in and save time and go in and look for specific key performance indicators, the metrics that I care about, and really kind of fact check things. And really for me, it saves time where you don't have to dive in deep on deals, that you can look at a few metrics and understand if it's not a good fit early on. And it saves you a lot of.
Do you use any other tools aside from like ChatGPT or maybe Perplexity, something more specific to what you do?
I use Claude for putting content together, reporting. Also, as well, Gemini is another one that's very similar to ChatGPT, their Google equivalent. So I would say those are the big ones I am looking at.
Yeah, there's a lot of opportunities out there, and it's crazy how quickly they're like the market, the tech market is evolving for that. So,
Yes.
lastly, if you could go back to your first day in the Air Force and tell the younger version of yourself one thing about building a legacy, what would that be?
Yeah, that's a great one. And I think looking back, 20 years ago, with building the legacy, I would say start buying multifamily sooner and go bigger soon. I didn't buy my first apartment complex until I was 2020. So that was 15 years later after being in the military, And so for me, that is really go bigger sooner. And it really comes down to my mindset. And it took a long time to get past the mindset of kind of the limited beliefs on just, buying a single family home and just that you had to be a multimillionaire to afford an apartment, and not really knowing like the creative strategies to buy multifamily and how to put a team together to buy multifamily. So for me, it would definitely be centered around with building wealth and buying multifamily earlier, especially if I could buy something back in 2008, 2009 to buy on the market. It'd be great.
That would have been the year of success for everybody, if we have the knowledge that we have today.
Right.
Yeah. Thank you so much. That's been very educational, informative, and I really enjoyed our conversation.
No, this has been great. And hopefully your audience, they were able to glean something from our conversation today. And yeah, love to be a resource in the future.